I've said it before and I'll say it again. Car loans are the downfall of the American middle class. There's a good argument to be made that car prices have skyrocketed in the recent years, and no one is denying that fact. Anyone who has gone car shopping recently knows how shocking those price tags can be. But here's the thing, the average monthly car payment in the US has hit an eye-watering $734 a month. Sure, rising prices play a role, but $734 a month? Now couple that with the fact that loan terms are getting longer as well. That monthly payment does not tell the full story anymore. It's worse than that. It's actually much worse. The length of these loans is creeping up, hitting buyers with what I call a double whammy. Shockingly, about 20% of all new car loans have stretched out over 84 months. Think about it, 84 months. That's 7 years of paying for a car that loses value the moment you drive it off the lot. And over those 7 years, the total cost of the car when factoring in interest is likely to be thousands of dollars more than you initially thought. But what's worse is that these car loans don't just impact your immediate finances, they erode the very foundation of your financial future. Every dollar that you put into that long-term loan is a dollar that you're not investing or putting towards your financial safety net. So before you fall into the trap of thinking that an 84-month loan is the key to affording a new car, let's break down why that belief is one of the worst financial mistakes you can make. At first glance, the appeal for an 84-month auto loan is obvious: the lower monthly payment. On paper, it seems like the dealership is doing you a favor by spreading out the cost over a longer period, and you can finally afford that dream car. But this is precisely the psychological trap that dealers want you to fall into. By focusing on the monthly payment, they distract you from the actual cost of the loan and the car itself. Dave Ramsey has famously said that just because you can make the payments does not mean you can actually afford it. And it took me a while to realize that just focusing on the monthly payments is a trap. Let's use a real world scenario to explain this. Say you've got your eye on that car that costs $30,000. The dealership offers you two financing options: a 60-month loan at 6% interest or an 84-month loan at 7% interest. For a 60-month loan at 6% interest, your monthly payment is $580. The total interest that you pay is $4,800, and the total cost of the car is $34,800. On the 84-month loan at 7% interest, the monthly payment is $453. The total interest is $8,034, and the total cost of the car is just over $38,000. At first, the 84-month loan seems appealing because you're paying $127 less per month. But here's where the trap lies. Over the life of the loan, you'll end up paying $3,234 more in interest, and the car will cost you a whopping $38,000. But that's not even the real problem. The silent killer, depreciation, is another critical factor. Cars are notorious for losing value as soon as they leave the dealership. In fact, most vehicles lose around 20 to 30% of their value within the first year. By the time you're halfway through an 84-month loan, your car may only be worth half of what you originally paid. Yet, you'll still owe thousands more than it's worth. As an example, in year 5 of your 84-month loan, your car could be worth as little as $12,000. But at that point, if you still owe, let's say, $15,000 on the loan, you're underwater by $3,000. And that's if you haven't rolled in any previous negative equity in the loan. By the way, this is a very common scenario. In fact, these figures are from a real world scenario shared by a gentleman on Facebook. This negative equity can be a real burden if you need to sell or trade in the car before paying off the loan. You'll either have to pay out of pocket to cover the difference or roll in that negative equity into your next loan, creating a cycle of debt. Dealers know that most buyers come in focused on what they can afford per month. They also know that many people struggle to think in terms of the total cost of the car. So they exploit this by offering longer term loans with lower monthly payments to make sure that the car seems affordable. And this psychological trick actually works. After all, the difference between paying $500 a month and $700 a month feels substantial. You might think I can do more with that extra $200 per month. But this is a short-term mindset. this kind of thinking also ignores other financial responsibilities that come with owning a car, like insurance, maintenance, and repairs. All these costs add up, and as your car gets older, the likelihood of expensive repairs increases. By the time you're in year 6 or even year 7 of your loan, you may find yourself facing a hefty repair bill on a car that's still costing you hundreds of dollars a month in payments. Let's talk about negative equity in a bit more detail. One of the worst financial traps of an 84-month loan is the risk of negative equity or being upside down on your loan. As we've already discussed, cars depreciate rapidly, and if you finance over a long period, you'll spend much of the time owing more on the car than what it's worth. If you decide to trade in that car before the loan is paid off, you will have to roll in the negative equity into the next loan. This is how buyers get trapped into a cycle of debt. Imagine this scenario. You take out an 84-month loan on a car, but 3 years in, you decide to trade it in for a newer model. Your current car is worth $15,000, but you still owe $20,000 on the loan. The dealership offers to roll the $5,000 of negative equity into your new loan. So now you're financing $35,000 on a $30,000 car. Add in the interest and you're paying even more in the long run. This cycle can continue indefinitely, leaving you paying off old cars while financing new ones. There's also the issue of opportunity cost. When you're locked into an auto loan, you're diverting money away from potential investments. That $700 a month you're paying each month towards your car could be used to build an emergency fund or to contribute to retirement. As I said at the start of the video, car loans and student loans to some extent are the downfall of the middle class. Over the course of 7 years, those missed opportunities can really add up. For example, if you invest that $700 each month into a fund with a 7% return, you'll have over $70,000 by the time your loan is paid off. Money that could be growing instead of being spent on a depreciating asset. So what's the solution? If you're in the market for a new car, but want to avoid the trap of a long-term loan, here are a few alternatives. First, buy a slightly used car that has already depreciated 20 to 30%. Like I said earlier, most new cars will depreciate 20 to 30% in the first year alone. And a car that is 2 to 3 years old has already taken a good chunk of that depreciation hit. Second, pay cash. If you're like me, the best way to avoid the pitfall of financing is to pay cash for your car. And I understand this might not be a realistic approach for everyone. Even saving for a few years can make a significant difference. I personally would rather pay cash for a depreciating asset, an asset that is guaranteed to go down in value. And third, if you absolutely need to finance, aim for a loan term of 60 months or less. This will help you pay off the car faster, reducing the amount of interest you'll pay, and minimize the risk of being upside down on your loan. Remember, a car is a depreciating asset. It's simply a tool to get you from point A to point B. Now, I'm not against anyone wanting nice things, but there's a big difference between making the payments and being able to truly afford the purchase. If you take one thing away from this video, let it be this: the opportunity cost of that $700 monthly payment is enormous.